Let's get more reaction with Cyrus De La Rubia. He's chief economist at Hamburg Commercial Bank, joining me live early this morning from Berlin. Cyrus, welcome to the program. Thanks for being here. So we have just seen the ECB cutting rates for a third time. Interesting commentary from Madame Lagarde there, saying we may not have necessarily broken the neck of inflation. So was 25 the right move this time round, or should they have gone for 50?
No, I think that this was quite okay, and overall, Lagarde sounded rather dovish in my view. She did not go so far to declare victory on inflation, but she suggested that we are pretty near this goal. And well, there has been some hope that she would be more explicit about December meeting, but she was only explicit in saying that she will not pre-commit on what the ECB will do at this meeting. So this may have to do also with the oil price spike that we saw at the beginning of October, which reminded the ECB that an oil price shock could occur at any time, given the tensions in the Middle East. But putting such risk aside, it would be rather surprising not to see a rate cut on December 12 when the meeting is taking place.
Okay, so looking to December now, I want your take on how the ECB is going to balance further rate cuts now that policymakers are talking about reduced inflation risks, but at the same time weakening global growth as well. As an extension to that, of course, no shortage of risks on the horizon as well. You just mentioned the potential to see an oil price spike. We're also coming into a really critical US election in just a few weeks' time that could ultimately change the economic narrative, change the economic trajectory for Europe itself.
Yeah, absolutely. And Lagarde also answered to this question, what about what would happen if Trump would be in charge in the next year. And she said, okay, this would certainly dampen our economic outlook if protectionism would arise. However, I don't think that the ECB would react immediately to such an election outcome. The ECB would wait for the new government to act, and then see if more action is needed. It is a downside risk for interest rates if there is an election of Trump, I would say, because higher tariffs would mean that our growth is dampened. On the other hand, higher tariffs means also that the dollar would appreciate and the euro would depreciate, which puts, on the other hand, more pressure on import prices. So I think she will wait for the outcome and then see what the government really will do.
Okay, it's going to be very fascinating to watch. And, Cyrus, I wanted to ask you as well, in terms of the implications for the investor here, what do you think this most recent cut is going to mean for risk assets across the Eurozone moving forward and sovereign bond spreads as well?
Well, obviously the markets are expecting more rate cuts to come. And this by its own means that for risk assets, the environment is getting better. However, I would be a little bit cautious because while Lagarde sounded quite dovish and she was quite convincing, and she did not go so far to announce for the rate cuts, but between the lines you could see that. I'm quite pessimistic on the further path of inflation. So I would rather expect that inflation will pick up not only in the fourth quarter, as Lagarde herself has said, but also during the next year, because I think that there are demographic, there are climate change issues, and there is also the issue of deglobalization, all things which are having an impact on inflation, which puts more upward pressure to inflation. And this would mean that the ECB may hold on cutting rates earlier than markets are expecting at the time right now. So if you go all into risk assets right now, then you may be disappointed when in the first quarter the ECB stops to cut rates.